When I traced where a lot of the loudest takes about BRICS monetary strategy were coming from, it was not from people reading institutional settlement design or bilateral trade language. It was from people bouncing between fantasy and dismissal. Either BRICS had already replaced the dollar overnight, or BRICS was just a press conference with no consequence. And that is exactly the kind of bad framing that gets regular investors lost. Because what was actually launched matters, not because it ends the dollar tomorrow morning, but because it changes the direction of travel in commodity pricing and reserve behavior right now as we speak. And I think you deserve the full story, so here it is. I am recording this right now from Los Angeles, and I want the timeline to be crystal clear, because this story moves in layers, and the first layer is always misunderstood. So comment what day and date you are watching from, because I love seeing how far these videos travel. And real quick, if you value this kind of street-level institutional breakdown, do me a favor, subscribe, and comment FinTalk OG so the algorithm knows you want more of this. Now here is the viral claim making the rounds. BRICS is either meaningless theater or it is the immediate death of the dollar. Those are the two versions getting pushed hardest. And on the surface, both sound emotionally satisfying, depending on which side of the argument you already like. But when you slow it down piece by piece, you realize both versions leave out the thing that actually matters. The mechanism. The first place these stories usually get weak is when people confuse a system challenge with a system replacement. Those are not the same thing. Replacing the dollar as the dominant global reserve and trade unit is like replacing the foundation under a building while people are still living inside it. It is slow, messy, expensive, and politically difficult. Challenging the dollar at the margin by routing more trade through non-dollar channels is much easier. And that second thing is already happening. So I am going to break down three things. First, what BRICS actually launched and why the mainstream either laughed at it or exaggerated it. Second, how this kind of non-dollar settlement quietly weakens the dollar's grip on gold pricing over time. And third, what it actually means for you if you are watching gold, silver, and the broader hard asset space. You are going to walk away calmer, sharper, and more in control of what you own. So let us start with what we can verify. The BRICS story is not really about one magic currency. It is about settlement architecture. It is about making it easier for participating states to transact energy, commodities, and strategic goods without touching the dollar at every single step. Here is the clean way to think about it. Most people watch the speedometer. They watch the headline reserve share of the dollar and say, look, it is still dominant, so nothing changed. But the gas pedal is the settlement system under the hood. If more trade starts happening without needing dollar intermediation every single time, then the demand for dollars at the margin weakens even if the dollar remains dominant overall. That is how big systems actually shift, not all at once, at the margins. Through use case by use case erosion. Let me be blunt. A 7% weakening in the dollar's commodity pricing grip does not sound dramatic to the average person. But in a market as large as energy, metals, and reserve management, a few percentage points at the margin are not small. They are strategic. Because once counterparties learn how to settle outside the old pipe, they are less captive to it the next time. That matters for gold, because gold is one of the few reserve assets that sits naturally between blocks. It is neutral enough to be useful. It is portable enough to matter. And it does not carry the same direct political liability as holding someone else's currency. Now here is the skeptical alternative. Could BRICS still amount to less than the hype crowd thinks? Absolutely. I am going to say something that might annoy both sides. The dream that BRICS just flips a switch and creates a full rival global monetary order overnight is nonsense. That is plausible here is how it can fail. Member states have different interests, different domestic vulnerabilities, different capital controls, and different trust levels with each other. Coordinating a unified monetary architecture across that many moving parts is hard, very hard. A correlation is not a contract. Trade settlement experiments do not automatically become reserve dominance. But here is where the skeptics fail, too. They act as if something only matters if it becomes total. That is childish thinking. Partial alternatives matter. Parallel pipes matter. Optionality matters. Same asset, different interpretation, depending on whether you understand how system erosion works. Stay with me on this because it matters. The dollar does not need to collapse for gold to benefit from BRICS-style settlement expansion. All you need is a larger share of commodity and bilateral trade happening in ways that reduce forced dollar demand at the margin. That changes reserve incentives. It changes what central banks want to hold as backup trust. And that usually means more gold, not less. Gold thrives in a world where trust fragments. It does not need a winner-take, all reset to matter. Here is a question for you. Do you think the real BRICS story is about replacing the dollar or simply weakening the dollar's monopoly at the margin? Drop that in the comments because the answer changes how you model gold completely. Now let us talk about how this touches gold pricing, because this is where importance really lies. Commodity pricing has long been tied to dollar settlement infrastructure. Not just the currency itself, but the payments rails, the invoicing norms, the swap lines, and the reserve recycling system behind it. When even a small share of that flow starts diverting into non-dollar channels, something subtle happens. Gold becomes more attractive as a confidence bridge. It is like a pressure valve in a system where trust is becoming less centralized. Countries do not need to fully trust each other if they both trust gold enough to hold it as reserve ballast while experimenting with other settlement routes. That is why central bank buying and non-dollar settlement efforts often travel together. Now here is what nobody wants to say. The Western financial media tends to treat BRICS initiatives as either unserious or threatening, but rarely as what they often are: incremental, messy, and strategically real. And incremental, messy, strategically real changes are exactly the kind that markets price late because they do not look exciting until enough of them stack together. Time is the weapon here. It is not the one announcement. It is the accumulation of operational habits over years. If you want to understand whether this scenario is building, you do not just watch the dollar index. You watch bilateral trade agreements, central bank reserve composition, and gold import behavior together. Those are the three tells. If all three are moving in the same direction, the story is real even if television still wants to argue about whether BRICS is a joke. Now here is a simple action plan. No drama. Step 1, decide whether you view gold as a pure inflation hedge or as geopolitical monetary insurance. Write it down. Because if you understand the BRICS story correctly, the second frame becomes more important. Step 2, track central bank gold buying and non-dollar trade agreements together, not separately. Do not make the common mistake of putting geopolitical settlement shifts in one mental box and precious metals in another. Step 3, if you own gold, own it with the understanding that it may respond in stages, not all at once. The structure can improve before the chart explodes. Step 4, if you are adding exposure, keep it sane. Gold can move slower than your emotions want it to, and then faster than your comfort level expects. Now let us map two plausible paths without pretending we can predict the exact candle. Path 1 is the gradual erosion path. BRICS and aligned states keep adding settlement capacity outside the dollar. More bilateral trade gets routed through new mechanisms, and central banks quietly keep increasing gold as neutral reserve ballast. In that world, gold benefits not from one giant shock, but from the slow weakening of forced dollar demand. I am not predicting it. I am saying it is within the set of things this market is capable of doing. Path 2 is the frustration path. BRICS coordination stalls, political disagreement slows implementation, and markets dismiss the effort as underwhelming. Even then, some of the plumbing already built remains useful. That is why I am not overly interested in the headlines. I am interested in whether the pipes exist once the cameras leave. Now here is the uncomfortable truth. Retail investors love stories with a launch date, a symbol, and a clean conclusion. Systems do not work like that. The real monetary shifts happen in boring documents, secondary trade routes, and reserve adjustments nobody discusses at dinner. Institutions protect themselves quietly while you wait for fireworks. And if you are not prepared for this version, you will either chase too late or dismiss too early. Here are the 4 rules. 1. Decide your maximum allocation first. Write it down. If you are losing sleep, you are too big. 2. When something runs hard and you are up a lot, take some off. Not all, some. If your position doubles, consider trimming half. Lock in the original bet. Let the rest run. 3. Do not confuse geopolitical narrative with immediate market mechanism. Some structural shifts take time. 4. The best time to buy is not always when you are most excited. The best time to buy is when you can still breathe. So here is what we covered. BRICS does not need to replace the dollar overnight to matter. Settlement architecture changes are real even when they are partial. Partial settlement shifts reduce forced dollar demand at the margin. Reduced forced dollar demand raises the strategic appeal of gold as neutral reserve ballast. And the biggest mistake investors make is waiting for a theatrical ending instead of tracking the quiet middle stage where the real repositioning happens. Stay alert. Stay thoughtful. Do not let clean narratives fool you into missing messy reality. Now here are my questions for you. Is BRICS more likely to weaken the dollar gradually or fail to coordinate enough to matter? And are you buying gold as inflation insurance or as a hedge against a more fragmented reserve system? Drop your answer below and remember to include what day and date you are watching from. If you got value out of this, subscribe and comment FinTalk OG so I know you want a follow-up when the next settlement or reserve shift lands. And if this helped you, share it with someone who still thinks the only 2 options are dollar forever or dollar collapse by next week. Keep your head clear, and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation. And if you need personal advice, get it from a qualified professional who knows your situation.